Statement of cash flows. What is cash flows? A cash flow is a statement of cash flow is a statement that shows the relationship between the liquidity and profitability of an entity. It shows the relationship between the liquidity and the profitability. Are we there? So,
please, we can't hear you. Please speak up.
I said statement of cash flows is a statement that shows the relationship between the liquidity and profitability of the entity. Shows the relationship between the liquidity and profitability. So cash flows are inflows and outflows of cash. Inflows and outflows of cash and cash equivalents. Cash flows are inflows and outflows of cash and cash equivalent. Inflows and outflows of cash and cash equivalent, that is cash flows. In accordance with IAS 7, we have two methods of preparing statement of cash flows. Number one, we have direct method. Direct method shows the basic cash flows from operating activities. Direct method shows the basic cash flows from operating activities. Direct method shows the basic cash flows from operating activities. Examples of cash flows from operating activities include cash received from customers, cash paid to suppliers, interest paid, taxes paid, other operating expenses. So this section directed to include our distribution, cost, and administrative expenses. It is direct method that will show these items under what? Under the operating activities. We said direct method shows the basic cash flows from operating activities. Under direct method, the operating activity will contain items as listed on the board. Operating activity will contain those items listed on the board. That is under the direct method. The second method is indirect method. Indirect method reconciles the operating profit. Indirect method reconciles the operating profit with cash flows from operating activity under the heading operating activity. So what this means is that under your operating activity using indirect method, what we normally do there is reconciliation. What you want to do, you reconcile your operating profit with what? cash flows from operating activities under indirect method. Reconcile your operating profit with cash flows from operating activities under indirect method. So it means you want to convert your profit before tax, you want to convert it to cash. How do you convert your profit to cash? Remember, your profit was prepared using what? Accrual basis of accounts. And your cash follows what? Cash basis of accounts. So in converting your profit to cash, you eliminate the impact or effect of accrual items. To convert profit to cash, you eliminate the impact or effects of what? Accruals from the profit. Then, if those adjustments are made, what you will have as the end result will be cash. There are a number of items that are part of the financial statements in line with accruals that will require adjustments, that it is only accrual financial statement that will show them. You can never have them in cash book. You can never have those items in cash book. It is only accruals that will contain those items. Among them include the non-cash items. You can never have non-cash items in your cash book, because your cash book is prepared in line with cash basis. Non-cash items, anything that doesn't relate to cash, will never appear in the cash book. And examples of non-cash items you may have in accrual financial statement include: number one, depreciation, amortization, depletion, and impairment loss. Depreciation, amortization, depletion, impairment loss. Accrual shows them, but not cash. Accrual contains those items, but cash does not. So if those items have been charged, they were normally charged as an expense, that means the profit has been reduced by them. What would you do when you are reconciling your profit to cash? You want to convert your profit to cash. So since profit has been reduced by those items, what would you do with them? We add them back. The depreciation, amortization, impairment loss, you add them back. I am still on non-cash items that are usually recognized in accrual basis, which are not part of cash. Number two items that you might have as non-cash items include the loss or profit from disposal of non-current assets. Loss or profits. Loss or profits from disposal of non-current assets. Loss or profit from disposal of non-current assets. It is accrual financial statement that will contain this. It will never appear in cash book. It will never appear in cash flows. The profit from disposal, you arrive at profit where the proceeds from disposal is greater than the carrying amount. The profit follows accruals. It is accruals that we talk about profit. We don't use to talk about profit in cash book. You can only have cash in hand, cash at bank. Nothing like profit. So if you have profit or even a loss from disposal of an asset, it is accruals that will give birth to them. You will never have them in the cash book. So if you have profit from disposal, remember, you are converting your profit to cash. What is the implication? Which profits are we even converting? Profit before tax. That is the profit we are converting. So if you don't have profit from disposal, what impact will the profit from disposal has on your profit before tax? What effect or impact does profit on disposal have on the profit before tax? Yes?
Profit on disposal is always in OCI.
No.
Non-current tax.
Profit from disposal is different from revaluation.
Okay, it increases our.
It increases the profit before tax. So that means if you have profit from disposal, you are going to subtract that. When you are converting from the accruals to cash, you subtract the profit from disposal. And if you have a loss from disposal, loss will have reduced the profit. Then what would you do? You add it back. You are lost from disposal. So I'm talking about what? Non-cash items, which are normally what? Recorded in what? In accruals. Which are not part of what? Cash flows. Which are not part of cash. That is number one thing. Okay, that's when you are adjusting, remember I've told you what we do under the indirect method. What we do in operating activity is what? Reconciliation. So that we know those items that requires adjustment. So that we know those items that will require adjustments under this heading. Now, number two. Number two, we are still on indirect method. Those items that requires what? Adjustment. Number two, we have non-operating cash flows or items. Non-operating items will require adjustment. Why are we adjusting for non-operating items here? These items, they are not operating activities, but their impact, their effect are already in operating profit. They are not operating activities. Their effects are already in the profit before tax. These items are not operating activities, but they have indirectly affected your what? Your profit before tax. For instance, when you have government grant income. When you have grant income, you are going to show it as an income, isn't it? Grant income will be shown as what? As an income. And if it is shown as an income, what happens? The profit before tax would increase, right? Since it doesn't relate to operating, you will need to do what? You will need to eliminate it. Grant income or grant received. So you eliminate its impact since it does not relate to operating. It does not relate to operating activity. You will need to eliminate its impact from the profit before tax, because you are converting your profit before tax to cash flows from operating activities. So anything that doesn't relate to operating, you have to eliminate their impact. Please bear that in mind. Investment income, such as dividend receipt. Is this operating? Is it operating? Has it not been included in profit before tax? It has been included, but since it is not operating, you want to get the portion that relates to operating. That investment income will need to be what? We need to be removed. Are you following me? And in the case of group, you might have share of profits of associates. If it is a group statement of cash flows, let me do that here. Share of profit or loss of associate. That is in the case of group financial statements, group cash flows. So, same happens to that. Share of profit or loss of associates. So you eliminate its impact because that profit is not from operation. This profit is not from operating activity. That is why its effect needs to be removed in order to get the cash flows that are from operation or operating activities. Are you following me? Interest income or interest received. Interest received is investing, not operating, but interest income will have formed part of your profit before tax. Since it has formed part of profit before tax, you will need to eliminate its impact in your reconciliation process. This is the number 2. We are on operating activities under what? Under what? Indirect method. I've told you what you do in this section is what? Reconciliation. And the third item that requires adjustment is changes in working capital. Changes in working capital. And working capitals are purely items of current assets and current liabilities. You will adjust for these items in your reconciliation. So, in the process of you doing this, you must exclude the items that are cash or cash equivalents. You must exclude the items that are cash. So I told you current asset, current liability. That means not every items of current asset and current liability you will need to adjust. The items of current asset or current liability that are cash, such as cash in hand, cash at bank, and cash equivalents, e.g. short-term investment, and those ones that will be adjusted in only of the elements used here, like interest payable, taxes payable. Those ones need to be excluded. So these are the 2 methods of preparing statement of cash flows. The only areas of difference between the 2 methods is what? Operating activities. That is the only areas of difference. Between the 2 methods, the only areas of difference is operating activities. I've told you, direct method shows the basic cash flows from operating activities. And I've given you examples or a number of items that will appear as what? Cash flows from operating activities under direct method. And I've also given you, I've told you under indirect method, your operating activity, what you do is what? Yes? I want to hear from online. What do you do under indirect method, your operating activities? You reconcile. So what we do there is reconciliation. Please bear this in mind. Having examined the 2 methods of preparing statement of cash flows, what are heading under which your cash flow statement can be prepared? We have 3 major headings. 3 major headings under which your statement of cash flows are or can be prepared. Number one is operating activities. Number one heading is operating activities. I've told you we have three major headings under which your statement of cash flows are prepared. Number one, we have operating activities. And I've discussed this heading under both methods. I've discussed the operating activities under direct method and under indirect method. Under direct method, what do you normally have as operating activities? Yes?
Cash paid to suppliers.
Cash paid to suppliers. Cash received from customers. Taxes paid. Interest paid, and so on.
Operating.
Yes. Then, but under indirect method, what do you do there? Under operating activities?
Time.
Huh?
Time.
You reconcile. So you prepare a reconciliation statement. And I've determined three different items that requires adjustment in the process of reconciliation. Now, the second heading is investing. Investing activities. Investing activities are activities that arises from changes in non-current assets and investment. The items we use to invest, I've told you they are activities that arises from changes in non-current assets and investment. Arises from changes when non-current assets changes. You could have an increase or a decrease. You may have increase or decrease. Changes in non-current assets and investments. That is investing.
Sir, can you take it again, please?
I've told you they arises from changes in non-current assets and investment. So whenever you get to this section of statement of cash flows, the first thing where your mind should go through or to is non-current assets and anything that affects your investment income. So that is where you should check. And the third heading is financing activities. Financing activities, there are two major sources of finance. What are sources of finance?
We have equities.
Debt and equity.
So, those are the two places you should check. Anytime you get to this section, you know that let your mind linger. Let your mind go straight to the sources of finance. Your mind should go directly to what? To sources of finance. And we have two major sources of finance, which are equity and debt. So where you have issue of shares, where you will have issue of loan notes, repayment of loan notes, and the dividend pays, and so on. When you have shares, you pay dividend to shareholders. So it relates to the source of finance. So these are the major headings. So the fourth heading is cash and cash equivalent. But most books did not take this as a heading. Cash and cash equivalent. What are cash? What are cash? Cash means cash in hand and demand deposit with a bank. Cash in hands and demand deposit. That is cash. Cash you have in hands already. All the money you have in the bank, I'm in need of my money back. You will just put the money there. 1 second ago. After 1 second, oh yeah, please, the money I just put into the account, give it back to me. The bank will say, take your money without you losing anything. That is demand deposit. But if the bank will now say, oh, this money you put in our account, our agreement is not that you will take the money back immediately. Your money is 1 million. We won't, even if you want to take it back, we are going to charge you for correcting it immediately. We will pay you 900,000 in place of 1 million. That one is not a demand deposit. The one payable on demand without you suffering any loss is demand deposit. Those of you working in the bank, you should understand what I mean. The money that the bank will be willing to pay, you put it, it's not even up to a second that you deposited the money and you are in need of the money back. I remember when I was in NYC. Sometime we are in need, there was a day we were in need of money. The money we have in our account is not up to the money we need. And we discover that the money, there is a minimum amount that the bank will retain. But there is certain amount that we can be able to collect. So in order to be able to collect more of certain amount as of then, we have to put little money there in order to increase the amount we'll be able to take. And hadn't been we are going to do something for putting additional money, we won't have done that. So that is demand deposit. They are payable on what? On demand. That is cash. That is cash. I've told you, I didn't say cash at bank. Cash in hand and what? Demand deposit. There are money that you will put in a bank. If you go to them, okay, you just put the money, give me that money. The bank will say, we will not pay you a fool. What type of money is that? If you freeze your deposit. So, after a few seconds, maybe it is still at the bank now. Is it not cash at bank? So, it is cash at bank. But the monies are not what? Payable on demand. That is the one that is not payable on demand. Is not cash. That is why I said cash in hands and demand deposits. Please take note of that. Cash equivalent is another concept on its own. So what is cash equivalent? Cash equivalent are short-term, highly liquid investment. Cash equivalent are short-term, highly liquid investment. Short-term, highly liquid investment that can be convertible or that can be converted to cash. At any time or at any point in time without any loss in value. They are short term. You can convert them to cash. They will not lose anything. I need the money immediately. Oh, I want to sell this thing. You will be able to sell it and get your money back. So they are cash equivalent. They are equivalent to cash. They are not cash in real sense. They are investment, but they are equivalent to cash because you can realize them easily. You can sell them easily without you losing anything. That is cash equivalent. Hope you are following me.
Yes.
Example of cash equivalents are what? No. Inventory is not a cash equivalent. You might have some inventory in hand and you say you want to sell it. Somebody will say, Tebo, the person is desperately in need of money. So the inventory worth 1,000 naira. They will say, okay, I will give you 800 naira. If you cannot take 800 naira, take your inventory. Because you are desperately in need of money, then you won't be able to sell the inventory. Inventory is not a cash equivalent.
It's critical treasury bills.
Treasury bills. That is an example. If in your question, if you see any investment under current assets, if you see investment under current assets, you know it is cash equivalent. Please, listen. We want to consider the format for preparing the statement of cash flows. I want to start with direct method. Direct method of preparing statement of cash flows. Please pay attention. I'm trying to summarize the whole thing so as not to waste time, and I don't want to leave out any important concept. That is why the approach I'm using now, I can even say I'm a little bit digressing from my previous teaching on statement of cash flows. But so XYZ Limited statement of cash flows. It is financial statement. Statement of cash flows is part of financial statement. So it is wrong to use as at. It is part of financial statement. So it is wrong to use as at. I've seen tests that use as at is wrong. Go into the Pathfinder any solution of statement of cash flow. If you see them using as at, that means the person who solves it doesn't know what he is doing. It is not even possible. I've not seen that in ICAN Pathfinder before. But I saw it in the textbook using as at. It's wrong. Statement of cash flows for the year ended. Put the year end. So for the year ended, please bear that in mind. Don't use as at I'm on my knees. Don't use as at I am on my knees. I am appealing to you now. Use for the year ended. So, you must prepare your statement of cash flows under those headings we were examining. Operating activities. Operating activities. So, where the direct method is required, in most cases, the items will not be given directly to you unless you are given cash book. And where you are given cash book, ICAN will surely require you to also use indirect method. Where you are given cash book, because they have already knew that everything you need will be found in the cash book. That means what ICAN is interested in there is the operating activity using indirect method. Because the information you need under direct method, you can obtain everything from the cash book. So, and I think I've only seen a diet where I can give cash book. And then they also ask for reconciliation of the operating profit under the B part of the question. So, operating activities, we have cash you received from customers. Cash received from customers. Working number one. So, cash received from customers. Working number one. Cash received from customers. Cash received from customers. For the purpose of statement of cash flows. For the purpose of statement of cash flows preparation, You'll be given two statements of financial position. The reason for that is for you to be able to know the opening and closing balances. And the minimum statement of profit or loss is 1. But the examiner might give you statement of profit or loss for the comparative year. If they give you statement of profit or loss for comparative year, now we are in year 2026. If I want to give you questions, they might give you for 2025 and 2024. If you are now given statement of profit or loss for 2025 and 2024, and you are preparing statement of cash flows for 2025, the profit or loss information for 2024 is not relevant. It is just a comparative figure. Don't even look at 2024 at all. Profit or loss, don't need it. It is comparative figure. But the statement of financial position, you need that of 2024 and 2025 for you to ascertain the opening and the closing balances. Anytime we talk about opening balance will be found in the opening statement of financial position, while the closing balances will be found in the closing statement of financial position. Please bear that in mind. So, cash received from customers will not be given. There are a number of items that have to do with customers that will be obtained from the financial statements. A number of items in your statement of financial position, you will see receivables there. What is the meaning of receivables you have in the statement of financial position? The receivables you have in the statement of financial position, what does it mean?
Expected cash from the debtors.
That is the amount. You said? How would the receivable be a liability? That is the amount customers are owing. That is the receivable. Customers are owing you this also amount at the beginning of the period, and at the end of the period, this is the amount they are owing. In normal adjustments, I will always start with the opening balances. I've told you that the opening balances will be found in the opening statement of financial position. In normal adjustments, I will be starting with the opening balances. We start with, this is cash received from customers, opening balance. That is receivable, that is the amount customer owns at the beginning of the period. We have one assumptions in accounts. The assumptions behind the preparation of statement of profit or loss is that all transactions are on credit. That is accruals. Accounting assumptions is that everything are on credit. So, if your revenue is on credit, no customer will owe you this at the beginning. You make more sales on credit. What will happen to the more customers are owing?
It increases.
It will increase. That is why you add your revenue. If any of those debts become bad, we have bad debts written off. What will happen to the amount owed by customer?
It will reduce.
It will reduce. So you subtract bad debts written off. We don't adjust for provisions for bad or doubtful debts in receivables. Provision, in fact, provision for bad or doubtful debts doesn't go to control accounts. Doesn't go to control accounts. Because normally I'm supposed to prepare receivable ledger control accounts. If I should be doing that, it might be given ledger, gives students more problems. So that's why I'm avoiding ledger. If you understood how these things happen, you just post, you discover, you solve it. When Stephania first of all commented, when she shouted me on WhatsApp, she said, "Sir, 2 cash flow came out in our diet. You know what I did? I just copied your format to ICAN." And she came first in financial reporting. So it's as simple as that. Once you understood the procedures to discover ICAN is very simple. So, bad debts written off. Then if there is a discount allowed, but it's unusual because you'll be given a public financial statement unless it is given, you are given as a breakdown among the expenses. If there is discount allowed, what impact does it have? Discount allowed. Tell me what happens.
It reduces.
You
It reduces the amount owed by customers. So this is the amount supposed to be owed after this adjustment. You're supposed to have this after you have subtracted those things. This plus this minus all this. You're supposed to have this at the closing balance. It is possible the closing balance will be lower than what you have. You have closing balance. A closing balance of receivables. So after this, the cash received. It is this cash received that will be posted in your statement of cash flows. As simple as that. Please, after the class, carry the note. Picture what you were hearing from ICAN, or even when the video is released too, you can listen to it over. Picture it in your mind. ICAN said this. This thing is something that is happening, that is affecting you. Something you practice every day. So when you practice something, you picture accounting as if it is practical, then you will not be giving yourself enough time to understand it. But if you continue learning by format, format you come by, you start with this, we add this, you are still learning format. But if you want to learn it, these things is the amount customers are owing me at the beginning. I sell another one on credit, amount owed by customer will increase. Then there are bad debts. Then that means the amount owed by customer will what? Will reduce. Then there are discounts given to customers. Then the amount owed will reduce further. Then I'm supposed to have this as closing balance. After comparing the closing balance with what you actually have, then there could be, this is lower. Then the difference could be cash received from customer. When you study accounting that way, you understand it better. But if you continue to say, in the format, start with opening balance. Cash received from customers. So you are learning format. And when you are learning by format, you might find yourself in exams and the format will say, this is, I am like this. And you say, is it like this? Everything might now scatter. Because you learn by what? By format. But if you learn the way it happens, even though you are sleeping and somebody wakes you up, you'll be able to tell the person, this is it, and that is final. I've been teaching since now. This is the third. I don't even think I read anything from it. If I have learned this thing by format, if you have been watching my video, you see that there are always little changes in the approach in my videos. If I think this one will be better understood, I adopt it. This one will be better understood, I adopt it. So if I am making another video again, you will see different things. So please learn practically, not by format. So cash paid to suppliers. Cash paid to suppliers. Who are the suppliers? Who are the suppliers? Who are the suppliers?
Creditors.
Your
Or
creditors.
vendors.
If you say creditors, It's not all creditors that are suppliers. I disagree. Well, okay, can you tell me any creditor that is not the suppliers?
The one you are not owing. The supplier you are not owing.
No. If you are not owing, do you have the person as creditors?
No.
Lenders.
Somebody who lends you money, what do they supply you? They supply you with money. They didn't supply you with inventories. So we use suppliers in connection with inventories. Cash paid to suppliers who procure goods from them on credit. You've not paid them. You are indebted to them as a result of the goods bought from them. So you are owing them. That is why it appears as current liability in the statement of financial position. We have payable, accounts payables, or trade payables. That is suppliers. As usual, we have working number 2. Cash paid to suppliers. In all my workings, I normally start with what? Opening balance. Which of the opening balance? Payables.
Payable.
Yes, payables. Now, after this opening balance, what are you supposed to consider next? Remember, we consider revenue here for receivables. The next thing you are supposed to consider is what? Purchase. Thank you. You are supposed to consider your purchase next. We add purchases. But this, in exams, what will be given is published financial statements. In exams, what will be given is published financial statements, where there will be no purchases. Everything will have been what? Compressed. You have to look for your purchase. You look for it. How do you look for your purchase? Remember, when you are preparing trading account, you used to say opening inventory, opening stocks. Add purchases. Less closing inventory. That will give us what? Cost of goods sold. Make your purchase the subject. Your purchase will be what? Cost of goods sold plus closing inventory minus opening inventory. This will give you the purchase. But the question I want to ask you, in your published account, is it cost of goods sold they will give you?
No, sir.
What would you be given?
Cost of sales. Cost of sales.
Cost of sales. Is there any difference between the two?
There's no difference.
There
is. There is so.
Okay, tell me the difference between cost of goods sold and cost of sales.
They are the same thing now. Only people think there is. Tell us. They are not the same.
They are not the same. If they are not the same, tell me the difference between the two.
Cost of goods sold, that the amount of goods that was sold for that particular event, the cost of sales, after deducting closing inventory, you get your cost of sales.
This one carries goods. Cost of goods sold carries what? Goods. When we say goods, goods are what? Inventories. Okay? But cost of sales might contain non-inventory items, not non-inventory related items. Please mute your mic. Orumade. Mute your mic. Cost of sales might contain non-inventory related items. Remember, have you seen any question whereby the policy of the company is to charge depreciation to cost of sales?
Yes.
Is depreciation inventory? Is depreciation inventory?
No, sir. No cash item.
Yes, see, can you see that because of the depreciation that have been charged to get cost of sales now, it has made it different from cost of goods sold. So, your purchases, you start with what? Cost of sales. We want to convert our cost of sales to cost of goods sold. Think of converting your cost of sales to cost of goods sold. To convert your cost of sales to cost of goods sold, you go through the question. Are there non-inventory related items that have formed part of cost of sales? For instance, if you have factory overheads, especially for a manufacturing entity, it's already added. So you remove it because what we want to get is goods, is purchase. Purchase are goods. Purchases are what? Goods. So anything that doesn't relate to goods, you need to remove them. If depreciation have been included in cost of sales, you remove it. After this adjustment, please take note. Depreciation may be charged for administrative expenses or distribution expenses, so that you will not believe that it is all time that you will be removing depreciation here. You have to go through the question and be certain, where has this item been charged? You have to be sure they have formed part of cost of sales before you eliminate them. Are you getting what I'm saying?
Yes, sir.
Now, after this adjustment, you arrive at what? Cost of goods sold. We've eliminated the non-inventory items now. So, you will now get the value that relates to what? Inventories. After the inventory related items, what next? Now, you've gotten cost of goods sold, which is this. You now add closing inventories. You add closing inventories. You now less opening inventory, right?
Yes, sir.
Less opening inventory. After this adjustment, you arrive at what? Purchases. Your purchases will be added to the opening balance, just as we added revenue to opening balance in terms of receivables. After this, if there is discount received, so what would you do? If you have discount received, what would you do?
What it?
Now,
Subtract it.
okay. You sell goods to, you buy goods from the suppliers. Listen to me. You buy goods from suppliers worth 100,000, and supplier gives you discount of 5,000. How much are you supposed to pay?
95,000.
So what did we do? We subtracted the discount receipt. So that is why the discount receipt will be subtracted, just like discount allowed was subtracted here. So you have this. You now compare that with the closing balance. Closing balance, that is payable. Payables. After this, you get cash paid to suppliers. Cash paid to suppliers. Cash paid to suppliers. That will give you cash paid to suppliers. Please take note of this. So, now, there are number of expense in the statement of profit or loss. There are number of expense in the statement of profit or loss that relates to operating. What is the meaning of operating? When we say something is operating, what does that mean? Operating means what?
Using running the business.
They are the normal activities of the business. They are the principal activities of the business. What the entity is doing, that is the operating. That is the operating. Now, in running a business, there are expenses that are normal to the operation of the business. In running a business, there are expenses that are normal for the smooth running of the business. And those expenses are termed operating. Can give me any of them. Administrative expenses. Distribution expenses. Working number 3. Operating expenses. Operating expenses. Now, the item we normally adjust in expenses is accruals or prepayment. So if you have accruals, opening balance, accruals, those are the adjustments. You already knew what it means. Then administrative expenses. Admin expenses as per the trial balance. Distribution costs. So, there could be a number of items that will be charged. Number of items that will be charged to these expenses that are not cash. Remember, these expenses were reported in line with accrual basis, and we are converting from accruals to what? To cash. These expenses originally contained the expenses due that have not been paid. That is accruals. Accruals are amounts due but have not been paid. So, the non-cash items such as depreciation, amortization, depletion, impairment loss, loss from disposal might have formed part of these expenses. And all those items I've cited are not cash. So since they're not cash, what would you do with them? You have to remove them. I don't know if you are with me. Are we together?
Yes, sir.
Yes, sir. Yes, sir.
I thought you only do that when you are reconciling.
The reconciliation, the process is different. You are converting the expenses here. It's not the expenses you are converting to cash under reconciliation, under the indirect method. It is profit you are converting to cash. But this now, we are converting each item to cash. We want to convert the expenses to cash. We want to get the actual amount paid in respect of the expense. So these are what we need to understand. Cash flows is interesting. Now, depreciation have been included. Where depreciation have been included, what would you do? Remove it. But remember, depreciation that have been charged to cost of sale will not be included in either admin or distribution, unless they were apportioned. So it is the depreciation that have been included in either admin or distribution expenses that we are subtracting here. So don't think the same as depreciation will be here, it will be there. If you understood the principle, it is the one that goes to admin or distribution that is to be removed from distribution or admin. Then the rest, judicata. So the amortization, which have been included there, impairment loss that have been included there, then loss from disposal that have been included there, we subtract them. But do you know that the question by way of additional information, that you may be told the profit from disposal have been credited to administrative expenses? You've not seen that. The more questions you solve, the more your eyes will be opened to adjustments. Where the profit from disposal have been credited to expenses, that means the expenses have been reduced. So in that case, you will add them back. Profit from disposal of non-current assets. We add because it has been subtracted.
So is it with the same figure as the that of loss? With what you just explained,
the loss is different from profit. Loss normally, unless the question tell you that you charge loss to cost of sales, normally loss is supposed to be treated as administrative expenses. You write it off. But the profit may not always be here. But if it is going to be adjusted in expenses, the way the question is structured is what will determine whether it is adjusted here. They will tell you that the profit has been credited to administrative expenses. So you have it. You add it to the opening balance. You have this as the total. Then you now subtract the closing balance. Subtract the closing balance. Closing balance. After this, you have the cash page. Cash page. So that is cash paid to suppliers. Working number.
So it's operating expenses to operating, not cash.
Sorry, operating expenses. Thank you. Operating expenses. Working. So after this.
So please, I have a question, sir.
Okay, what's your question?
Yes, sir. You told us that for the indirect method, that we have to convert the items from accrual-based to cash-based. Are we also doing the same thing for the direct method?
No. Yes. What you are missing off is that indirect method It is profit. I said you reconcile your operating profit before tax. You reconcile it to cash flows from operating activities. You convert your profit to cash under indirect method. It's not expenses. Here now we are taking each item now, we are converting them to cash. That is under direct method. In order to get, if you look at the format I gave you cash receipt. When I was explaining the direct method, I said operating activity include cash received from customer, cash paid to suppliers, operating expenses. This figure will not be given in the question under direct method, and the examiner will ask you to use direct method. You have to look for them, and the procedure of looking for them is what we are doing now. But if it is indirect method, you don't need all these things there. It is profit before tax you will start with, and the profit before tax is what you will convert to cash, not each item as we are doing.
Okay, thank you, sir.
Thank God.
Hello, sir.
Yes, sir.
Yes, sir. Under the cash paid to suppliers, can we also have non-cash items in cost of sale, just like we have in this operating expense where you have depreciation and depreciation. The other ones, amortization.
Yes, you could have them there if the policy of the company is to include them in cost of sales. Yeah, they have been included.
Have them in both operating expense and cost of sales.
At the same time, you can't have them in both. You can't have them. You can't use them in both. Those ones that go to cost of sales and those ones that will be adjusted in cost of sales. Those ones that goes to operating expenses and those ones that will be adjusted in operating expenses, and not both.
It's not a sir.
At the time we are solving a question or a comprehensive question, you see how these things will be calculated.
Sir, please, I have a question.
Okay, ma'am.
Sir, can a question be given and is being silent about where we are to charge depreciation?
The question may be silent.
Yes.
Yes. Where are you supposed to charge depreciation if the question is silent?
What I've said.
You have to determine. You have to determine some depreciation, some assets. It's not all assets that you charge your depreciation to admit. For instance, what do you use motor vehicle for? What do you use motor vehicle for? Delivery. Distribution. So you assume depreciation of motor vehicle is distribution. But furnitures and fittings, land and building and others, you assume those one goes to admin. That is where the question is silent. Although we are treating both distribution and admin together here, so their depreciation should be adjusted in that. So now, interest paid. Interest paid. That is working number 4. Am I free to rub up this? Am I free to rub up that?
Yes, sir, carry on.
So, interest paid. Interest paid is different from interest received. Interest payable is different from interest receivable. What is the difference?
One is an expense, one is an income.
Okay, which one is an income?
One is an outflow, one is an inflow.
Okay, which one is an income?
Interest received is an inflow. It's an inflow. Interest paid is outflow.
Okay, number 4. Interest paid. So, as usual, we start with the opening balance, which is interest payable. Where are you supposed to see interest payable?
Statement of financial position.
Under
Non-current liability.
no.
liability.
Current liabilities. That is accrued interest. Payables and accrual are the same thing. The interest expense. Interest expense. The one charged as an expense in the statement of profit or loss.
Finance cost.
Yes, which is a finance cost. Finance cost. Then the sum of this, you now subtract your closing balance. Closing balance. Interest paid now. Outflows.
Where do you get the closing balance from?
After interest paid, we could have taxes paid. Taxes paid. That is working number 5. Working number 5, which is for taxes paid. As usual, you start with what? Opening what? Balances. Opening balances. We have current tax, current income tax, deferred tax. We start with the opening balance of both. Then you now have tax expense, the amount expense that starts in the statement of profit or loss. Now subtract closing balances, which includes current income tax, current income tax. Then deferred tax. So then after you subtracted the closing, you have tax paid. So include the tax paid. So we have net cash flows from operating activities. So that is the first heading. After operating activities, the next heading is investing activities. Investing activities. Investing activities. Investing activities, I told you 2 major things need to be considered here. We need to consider what? Changes in non-current assets.
Income from short-term investments.
Not short-term, short-term investment is cash equivalent. It's long-term investment, not short-term. Investment will have under non-current assets. So we have movement in non-current assets, which is working number 6. Movement in PP, property, plant, and equipment. As usual, we start with opening balance. Opening balance in respect of PP. So there are a number of adjustments that will affect the PP. Number 1 is what? Depreciation. Which are the depreciations? Depreciation reduces PPE. Which of the depreciation to be considered here?
The one charge on the bill.
The one charged for the year. Not the one accumulated for prior year. The depreciation charge for the year is what you need. Then we could have disposal. What will happen to PPE where there is disposal?
It reduces
The disposal here. So carrying amount. The carrying amount of the disposal. The carrying amount is cost less accumulated depreciation. That is what to be used here. Then after this, PPE may be revalued. Revaluation, surplus. And if it is deficit, evaluation, deficit. So you subtract the deficit. So you have this. If closing balance is greater, you have closing balance. Closing balance. Instead of PPE, we have acquisition. Of PPE. Acquisition of PPE. The acquisition of PPE will be reported as investing activities. Working number 6. Acquisition of PPE. Working 6. Acquisition, when PPE is acquired, PPE is bought, it will result in outflows of cash. That's why we put that in braces. Then you have the proceeds from disposal of PPE. Proceeds from disposal of PPE. Working number 7. Where this is not given, you will need to calculate it. To calculate the proceeds, you have the carrying amount plus profit from disposal minus loss from disposal, depending on the one you have in the question. I want to start from where we stopped last week. So we've started with investing activities. What are those things we recorded there? So last week, we recorded items such as what?
Acquisition of PPE.
Acquisition.
Acquisition of PPE.
Okay. Of PPE.
Of PPE.
That is working.
6.
Then proceeds from 6.
Acquisition is outflow.
6.
Okay. Proceeds.
Then
From
proceeds
what?
from
Disposal of PPE.
Yes.
That is working.
7.
7. Have we shown the working?
I have shown the working 7.
Okay. So we want to have working 7. So working number 7, that is proceeds. Proceeds from disposal of PPE. So where there is disposal of PPE, you will be given the cost of the PPE disposed. You take the cost if it is given, accumulated depreciation of PPE disposed. So if you subtract that, you arrive at the carrying amount. Carrying amount. So you may be given the profit from disposal of PPE. The profit from disposal of PPE might be given by the way of note, or you may see it in the face of statement of profit or loss, or it might be included in other income, and you'll be told in the note that other income include profit from disposal of PPE of this so amount. So you take the profit from disposal. If you have profit from disposal of PPE. If the PPE is disposal profit, you add the profit from disposal in order to arrive at the proceeds. But if the PPE is disposed as a loss, you have loss from disposal, loss from disposal of PPE. Loss will reduce it. Then you arrive at the proceed. And it is this proceed that will be recorded as an inflows under investing activities. So remember, I've told you investing activities arises from changes in non-current assets. So purchase of investment. In case you have purchase of investment, you can also check the movement in investment, where the closing balance of investment is greater than the opening balance. That means there could be purchase of investment, which will result in an outflow of cash. Then proceeds from sale of investment. Proceeds is an inflows. Proceeds from sale of investment and inflows to be added. Then there could be investment income. Then let me say dividend received. That is working number 8. Dividend receipt, where it is not given directly, you have to look for it. Calculation of dividend receipt. As usual, you start with the opening balance. Opening balance. That is dividend receivable. Take the opening balance in respect of dividend receivable, and sometime it will be recorded as investment income in the face of profit or loss. You have investment income. If any, you add it. Then you subtract the closing balance. Then you get the dividend received. This will be an inflows in the face of statement of profit or loss. Then interest received, working 9. Interest received. You start with interest receivable from, and this will be under current asset if any. So you may see it under current asset. Interest receivables. Interest, that is opening balance. That is interest receivables. Interest income. Interest income could be found in the face of the statement of profit or loss. So when you add this, you have the closing balance. Closing balance. That is interest, receivables. So after subtracting that, you will get the amount received as an interest in the period. Interest received. Working 9. Inflows. Government grant received. Government grant received. So government grant received. So this will appear as investing activities. After your plus or minus of all the items you have there, you have the net cash flows from investing activity. It could be plus, it could be minus. That is investing activity. The next heading is financing activities. Financing activities. Financing activities are those activities that result in changes in equity and borrowings. Financing activities are activities that result in changes in equity and borrowings. From that definition, you agree with me that every businesses have two major sources of finance. So the source of finance are what? Equity and debt. So it means when you get to this section of the statement of cash flows, you should always check the movement in equity and borrowings. So those are what you need to check whenever you get to this section of statement of cash flows. So you look at the sources of finance. So financing activity arises because of the way the business are financed. So financing activities. Financing activities arising because of the way the business are financed. And I've told you business will be financed with what? Equity and debt. So when you get to this section, you should always check the movement in equity, the movement in borrowing. So now, working number 10. Working 10. Movement in equity shares. Movement in equity shares. So, as usual, you start with the opening balance. Opening balance in respect of equity. Opening balances. Opening balances. So we have for ordinary shares. Opening balance in respect of ordinary shares. If you have share premium, consider its opening balance. So you could have bonus yield, and the bonus yield could be made from share premium, and it may be made out of retained earnings. So we have bonus yield. I've told you bonus yield could be made from share premium, it could be made from retained earnings. Normally, the bonus issue should be made from share premium. But where bonus issues are made from retained earnings, you will need the adjustment here. Bonus yield from retained earnings. Bonus issue from retained earnings. To add it. But if it is made from share premium, you ignore it. Bonus issue made from share premium should be ignored. Then you have the closing balances. Closing balances. It comprises of ordinary shares. Closing balances in respect of ordinary shares and the share premium. Ordinary shares and the share premium. So you subtract the closing balances, you will get the issue of shares. You get the issue of shares. Issue of shares. Issue of shares. This issue of shares will appear as financing activity. It's an inflows. Issue of shares and inflows. So, redemption of shares. Redemption of shares. Issue of shares, that is working number 10. Working 10. Then, as part of equity, you have retained earnings. And dividend may be paid from retained earnings. So we have working number 11, calculation of dividend paid. Dividend may be paid from retained earnings. We start with opening balance as usual. Opening balance. That is retained earnings. So you have profit for the year. You add this profit for the year. Profit for the year. You add that. Then you could have where bonus issues are made from ordinary shares, from retained earnings rather. Bonus issue from retained earnings. Bonus issue from retained earnings. So after this, you have closing balances. Closing balances in respect of retained earnings. Retained earnings. After this, you have dividend paid. It is this dividend paid that would appear as investing, that will appear under, financing activities in the statement of cash flows. Dividend paid. Outflows. Redemption of shares is also an outflows. Then you may also have repayments of loans. Repayment of loans. Where the closing balance is lower than the opening balance. So, issue of loan notes. Closing balance will increase where there are issues of loan notes. I'm tired of working notes. That is why I'm ignoring working notes here. I'm tired of working notes. It's getting too much, I mean. So you have the net cash flows. Net cash flows from financing activity. So it could be plus, it could be minus. After that, you add cash flows from operating, net cash flow from operating, net cash flow from investing, plus net cash flows from financing. The addition of the three will give you this. This is your net cash change. After the net cash change, you have cash or cash equivalent. Equivalent at the beginning. Net cash or cash equivalent at the beginning. If you add that, you get cash or cash equivalent at the end. So this is the format for preparing statement of cash flows using the direct method. So the only areas of difference between direct and indirect method is operating activities. It means the whole information you have under investing activities and financing activities will be repeated for indirect method. The workings, the adjustment you have under investing activities, same adjustment will be repeated for indirect method, and same for financing activities. So the only areas of difference is the operating activity. This question is obtained from ICAN May 2024 financial reporting question number 1. So, Badagry PLC statement of financial positions of March 2021. You have 31st of March 2021 and 31st of March 2020. Those are the statement of financial position. That means the one for March 2020, that is opening balances, while the closing balance is March 2021. You have PP, investment, inventories, trade receivables, bank, ordinary share priority earnings, no 10% redeemable loan notes, trade payables, taxation, bank overdraft, accrued expenses, total liabilities, statement of profit or loss, revenue, cost of sales, administrative expenses, distribution costs, finance costs, dividend receipt, profit before tax, income tax expense, profit for the year. You have additional information. 1. During the year ended March 31, 2021, plant and equipment with carrying amount of 40 million naira was sold for 55 million naira. The profit or loss on disposal was charged to distribution expenses. 2. Dividend of 2 kobo per share was paid in the year ended March 31, 2020, and there were also bonus yield. 3. Depreciation charge for the year was 10 million on furniture and 30 million of land and equipment. During the year, an investment which cost 12.5 million some years ago was disposed for 20 million. The profit or loss on disposal was charged to administrative expenses. Note 5. Dividend received were from investment in shares and immediate disposal of right issue from the investment in shares in a blue chip company required. First statement of cash flow for Badagry PLC for the year ended March 31st, 2021 using direct method in accordance with IAS 7. So the name of the entity is Badagry PLC. So you have Badagry PLC statement of cash flows for the year ended. The year end of the entity is March 31st, 2024. So amount is in thousands of naira. So the first heading should be what? Operating activities. Operating activities, I've told you, they include items such as what? It's 2024.
Cash received from customers.
Oh, it's 2021. So it includes what? Cash received from customers. That is working number 1, right? So you want to calculate cash received from customers now. Working 1, cash received from customers. Cash received from customers. So you start with what? You start with what?
Opening balance.
How much is that?
Opening balance of receivable.
How much?
60,000.
60,000.
60,000.
Okay, followed by?
Or 60 million.
Followed by what?
Revenue.
Revenue of?
Revenue.
How much? How much is the revenue?
490.
490.
Yes. What other item? What other item?
Bad debt written off.
How much? How much of bad debt written off? How much? So,
None.
You don't have
550,000. The next item should be what?
closing balance, the less closing balance of receivable.
Closing balance. Receivable, how much?
90,000.
So if you subtract it, how much do you receive?
Four
460,000. So that is working 1. Followed by what? The next item.
supplier.
Cash
Paid
paid to suppliers.
suppliers.
Working 2. Working number 2. Cash paid to suppliers. What will be your starting point? Opening balance. Payables. How much?
14,000.
14,000. Followed by what? Followed by what?
Calculation of purchase. Calculation of purchase.
We have purchases. How much your purchase? How much your purchase?
Cost of sales.
Well, we have to calculate it.
Cost of sales. How much is the cost of sales?
222,000.
22,000. Followed by
Yes, plus closing inventory.
How much is the closing inventories?
295,000.
Okay, closing inventories. 295,000. Yes. Subtract the opening.
Minus opening 120,000.
120,000. So, do the entity charge anything to cost of sales that doesn't involve cash?
There's nothing like that in our
Okay, nothing at all.
Nothing is charged to the
There's no note on opening.
Okay.
Yes, I think there's depreciation. Depreciation charge for the year. They didn't say it was not to cost of sales. But they didn't specify whether it was charged on cost of sales.
Okay. That means our purchases will be how much? 397,000. If you add it to 14,000 opening, you have 11,000. Followed by what? Okay. How much is that? Okay, closing balance. Payable 65,000. So you subtract that. 346,000. That is cash paid to suppliers. 346,000. Then, after that, the next item should be what?
Operating expense.
Operating cash expense. So, working number 3, operating expense. So, what will be the starting point?
Opening balance.
Opening balance, how much?
Opening balance is 50,000.
Opening balance.
So in the situation that if you have the page,
You reverse it. Opening balance accruals 50,000. If you have prepayment, you reverse the treatment. That means the closing balance of prepayment is what you are going to add. Less the opening. So, yes, what are other items you did here?
Admin expenses. Admin expenses.
Admin expense. How much?
90,000.
90,000.
admin distribution.
Yes, followed by distribution costs.
Distribution cost.
When you check the additional information, there's on 5 on the
Distribution
profit
cost.
and loss on disposal was charged to administrative expenses.
Don't worry. So, we've written the word in the statement of profit or loss. So, we go through the additional information. in order to know if there are anything that affects either admin expenses or distribution costs. Note 1. During the year ended March 2021, plant and equipment with carrying amount of 40 million was sold for 55 million. The profit or loss on disposal was charged to distribution. Is this sold at a profit or at a loss? Carrying amount is 40 million. It was sold for what? 55 million. Is that profit or loss?
Profit.
So we were told it was charged. Profit from disposal of plant and equipment. The proceeds is 55 million. And the carrying amount is 40 million. So we have 15 million profit. Are we to add it or subtract?
Add.
Why adding? Why not subtracting?
Subtract.
We are adding it because when you were preparing profit or loss, the distribution expenses has been reduced by that profit. The profit has been credited to distribution expenses. Since it was credited, that means the distribution expenses have been reduced by that profit. So to bring it back, you have to add it back. So you add it back. That is for note 1. Note 2, dividend of cover per shares. Okay, note 3. Depreciation charge for the year was 10 million on furniture and 30 million on plant and equipment. Where would this depreciation have been found? Where would they have been recorded? Depreciation would have been part of the expenses. Abi? Since depreciation has been part of expenses and depreciation is not cash, it's not a cash flow, we have to remove it from there. How much is it? 10 million plus 30 million. The depreciation is totaled 40 million. Are we to add it or we subtract? We subtract. But what if this were a loss? What would you have done? You subtract it because it have increased the expenses. And the loss from disposal is not a cash flow, just like the depreciation, you have to remove it. So please take note of that. Then the next note, note 4. During the year, investment which cost 12.5 million some years ago was disposed for 20 million. The profit or loss on disposal was charged to administrative expenses. It is sold at a profit or at a loss. It is
sold at it was sold at a profit.
Okay. Are we to add the profit or we subtract it?
We add it.
Okay, because the expenses, the administrative expenses has been reduced by that profit, because profit will have been credited there, leading to reduction in administrative expenses, so we add it. Profit from sale of investment, which is 20 million minus 12.5 million. So what will be the difference? 7.5 million. Hope you are following me. Hope you are following me.
So I didn't get this last explanation now.
Huh?
The last one is just explained.
It's blurry.
We say profit half since it was included in administrative expenses, and this is a profit. When the public financial statement was prepared, that means the administrative expenses will have been reduced by the profit, so you add it back. So what is the total of what we have here? 162. Are you sure? This is 110. Okay. Yeah, sure.
Yes, minus 40 now.
Okay, followed by what? What next? The next item should be what?
Should be closing balance.
Okay.
Closing balance of accrual.
How much?
That's 40,000.
Accruals.
40,000.
Okay. $40,000. 122,500. That is the operating expenses paid in the period. 122,500. So that will be treated as an outflows in our statement of cash flows. We have operating expense, operating expenses. That is working number 3. 122,500. 122,500. So, hope you are getting it. What next? 460,000, 346,000 minus 122,500. So we have minus 8,500 negative. The next item should be interest paid. Working number 4. You have interest expense under liability. There is no interest payable under liability. Abi? And by the way of note, are we told we have any interest payable anywhere? Do you have any information on interest payable anywhere? I know we have finance cost. Aside that finance cost, aside the finance cost, did you see any information about interest anywhere?
No, sir.
Okay, if there is none. So how much is your interest paid?
5,000.
The finance cost is the profit or loss?
5K.
Okay. 5,000. That is your finance. No working. No working for this. Finance cost of 5,000. The next item should be what? Taxes paid. Taxes paid. That is working number 4. Working number 4. Taxes paid. Taxes paid. Taxes paid. As usual, you are starting with the opening balances. Check your non-current liability. Do you have deferred tax there? No. Opening balance. How much is the opening balance in respect of your tax?
12,000.
12,000. In case you have any more, if you have, you also check your non-current liability. In case you have deferred tax there, the opening balance should be considered. The opening balance, deferred tax, we consider that. But since we don't have anything as such in this question, that is why we only use the taxation you have under the current liability as the opening balance. After this, we have income tax expense. How much is that? Income tax expense.
You have 70,000.
70,000.
Followed by closing balance. How much is the closing balance? Closing balance? 70,000. So the tax paid will be 12,000, right? You have 12,000. After this, we now have to have net cash flows from operating activities. 25,500 negative, maybe. That is net cash flows from operating activity, or net decrease in cash flows. You can have a decrease in cash flows from operating activities. Now that we've done with operating activity, what should be the next heading? Investing activities. And I've told you that these are activities that result in changes in non-current assets and investment. And I've told you that whenever you get to this section of statement of cash flows, you check the movement in what? Non-current assets. So, the non-current assets, working number 5. Working number 5. Working 5. Movement in property, plant and equipment. So, as usual, you start with what? Opening balance. How much is the opening balance in respect of the 110,000? Now, what are these transactions that affect people during the year? Is there anything that happens to people? So go through the note. You have disposal. This 110,000. The question I want to ask you is, the 110,000 recorded here, is it at the cost or at the carrying amount? Yes. What's your answer?
Carrying amount.
Carrying amount. Good.
Carrying amount.
Good. Good. Now we have disposal. Since this is at the carrying amount, and you want to treat your disposal, the disposal too must also be at the carrying amount. I mean, you know why the disposal should be at carrying amount now. But if this were at cost, then disposal too should be at the cost. Remember, you have a carry amount after depreciation have been deducted from the cost. Go to note 1. During the year ended March 31st, 2021, plant and equipment with a carrying amount of 40 million was sold for 55 million. The profit or loss on disposal of chattel and distribution expenses. So we have disposal of plant and equipment. How much? How much will be recorded here?
40,000.
40 million.
Thank you. Someone here has traveled. So he was saying 15. If you look at note 3, note 3 also has a bearing on the property plan and equipment. Depreciation charge for the year was 10 million on furniture and 30 million on plant and equipment. Depreciation. Both are PPE. 10 million on furniture and 30 million on plant and equipment. Depreciation is totaled 40 million. Hope you are following me.
Yes, sir.
Good. The
So,
next.
I have a question. That's PPE on natural balance. How do we know that it's on carry amount?
It's not in trial balance. It's in the statement of financial position. In the statement of financial position is a prepared statement, and a prepared statement of financial position, depreciation will have been charged before you arrive at the carrying amount that will appear in the financial statement. This is not a trial balance. Hope that is taken.
Yes, sir. Thank you.
Okay. Now, the notes for during the year, an investment which causes that is investment. It's not part of maybe dividend receipt. So, these are the PPE. So, after this adjustment, you have 30,000, right? Then you have closing balance in respect of PPE. So how much? 350,000. Okay. Now, this is extremely big. Look at the closing balance. It's larger than the 30 million you have. Your closing balance is supposed to be 30 million, but it appears to be enormously bigger than the 30 million you have there. So that means certain property were acquired during the period. You have an acquisition of PPE of 320,000. That is what? Acquisition of PPE, which will result in outflows of cash. You have acquisition or purchase of PPE, acquisition of PPE, outflows of cash of 320,000. Outflows, that is working number 5. Working 5. Hope that is taking. After PPE.
Hello, sir.
Yes, sir.
Sorry, sir. My concern now is that in our information 1, additional information 1, we recognize that 40,000 that is meant for plant and equipment. Then why do we now charge depreciation that is meant for both plant and equipment and furniture, and not the one that is attributable to plant and equipment alone, which is 30 million?
What is the meaning of PPE?
Property, plant and equipment.
What are property, plant and equipment?
It could be motor vehicle, furniture and building, building.
So the question you are now asking me now, hope you have answered yourself.
All are inclusive.
So you see, you ask me question and you happen to be the one that answered yourself. That is how accounting is. That is why I always tell you that you learn accounting practically, not theoretically. The question, if you have asked yourself the question I asked you, you wouldn't have asked me that question, because the question is a practical question I ask you that direct you to the answer, that directed you to the answer. So, back to the business. Don't mind me, ICAN is getting tired little by little. But we are using system. I'm using system so that the lecture will not be boring. Because if I say I am tired, if I'm not using the system I'm using now, the way I will be doing it will make it boring to you. And if it is boring, you will not find it interesting. So that is why I'm using system to create some humors and others to make you to be jeered. I believe you can remember, to be jeered. Tagad. Okay. Now, back to the business. The next item we have under the non-current asset is investment. So let's check the movement in investment too. Okay, the property, plant and equipment we also have disposal, right? The one that were disposed, the proceeds is already given. Proceeds from disposal of PP. How much is the proceed?
55 million.
55 million. Inflows or outflows? Inflows. Thank you. Now, we are still on the moment in non-current assets. The next non-current asset we want to consider is investment. Working number says, working number says, movement in investment. Movement in what? Investment. You say what? You say what?
Investment. Movement in investment.
So, back to the business. So, as usual, we start with what? Opening balance. How much is the opening balance?
30,000.
Opening balance of 30,000. Now, by virtue of the note, the information we have in the note, which note? Note 1.
Note 4.
Okay. Note 4.
Note 4.
During the year, investment which cost 12.5 million some years ago was disposed for 20 million. The profit or loss on disposal was charged to administrative expenses. So, this investment here, what is this value? The value of 30,000 here, do we depreciate investment? We don't use to depreciate investment. So this is fair value, which is tantamount to cost. This is at fair value, which is tantamount to cost. Therefore, if you are going to bring anything to this, your adjustment should all be at the cost. So, We have disposal of investment. How much? How much is the disposal? 12,500. So if you remove 12,500 from 10,000, what would you have? 17,500. Right? Then the next item to consider is what?
The disposal is 20,000.
Then we were not with us. Closing balance. How much is the closing balance?
60,000.
60,000. So if the closing balance is greater, what does that imply?
There was an acquisition.
Acquisition of investment during the period. Cash. How much is the cash paid? 42,500. Acquisition of investment. Working number 6. Outflows of 42,500. Now, investments were sold. When you sell investment, you receive cash. How much is the cash received on disposal of investment? You say what?
20,000.
So you have proceeds from disposal. You said the cash received is 20,000. You say what?
20,000.
So now the proceed is an inflow. You sell something, you get cash back. Now there are no other non-current assets. No other non-current assets. Now let's go through the notes to see if there are other items that will appear as investing. Note 1, we have recorded the proceeds. Then dividend of 2 kobo per share was paid. Payments of dividend is an outflows of cash, which is financing. That is financing activity. Financing activity. Note 3 is depreciation. Note 4 is about the investment. Note 5. Dividend received from investment in shares and immediate disposal of right yield from the investment in shares in blue chip company. You have dividend received from sale of investment. Or how much dividend received? How much is that? It is
153. 153.
How did you see the? Where did you see the 153? Tell me where you saw it, or you spared the solution.
In the statement of profit and loss.
Okay, let me check. Okay, we have it there. Thank you very much. 153,500. Inflow. Inflows.
No, statement of when there is receivable cost of sales.
Now, after these adjustments, you get the net cash flows from investing activities. Hope it's interesting.
Very good, sir.
Glory be to God. Glory be to God. What do you have as the total?
I got minus 134,000.
Okay, net cash flows from investing activity 134,000 outflows. Good. You say what?
Financing activities.
Okay. The next heading is financing activity. Financing activities. Remember what I told you earlier? That we have two major sources of finance. And the two major sources of finance are equity and debt. So, whenever you get to this section of the statement of cash flows, you check the movement of those two components. Now, we want to check the movement in equity shares. Movement in equity shares. Movement in retained earnings. Movement. Let me first of all do the movement in retained earnings. In case there is anything, because I saw somewhere that there is bonus issue. And the bonus issue will be paid from share premium. That is note what? Note 2. So, dividend paid. We want to, which is 2 kobo per share was paid in the year in the amount of 2021. And there were also bonus issues. So, it is because of this bonus issue story I saw in the question that is making me not to start with the movement in equity shares. I want to be 10 times sure that the dividend paid was not paid or made from the retained earnings. Remember, I adjusted for dividend paid, where in the format I gave you when I was looking at movement in equity shares. I said if it is paid from retained earnings, you will adjust it there. But if it is paid from share premium, that you should ignore the story about the bonus issue. Now, how much is the dividend paid? 2 kobo of the shares. How much is the number of shares yield and ranking for dividend? 2 kobo. 2 kobo. Of how much is the shares of the entity? How many shares? Ordinary shares. Capital of 80 kobo per share. The number of shares is what? 220,000 divided by 80 kobo. That will give you the number of shares in EU. The number of shares in EU, 220,000 divided by 0.8. You have 275,000 shares were issued. Dividend paid is 2 kobo times 2 kobo. Then you have dividend paid to be 5,500. 5,500. 5,500. Dividend paid and outflows of cash. 2 kobo times 220,000 divided by 0.8.
So why are we using the closing balance?
What?
Dividend of was paid in the
It is the share you have. We are preparing financial statement for 2021. It is the shares you have in 2021 you will pay dividend on in 2021. So that is why we use the closing balance. So I want to check the moment.
Sir,
You said
sir, but at times, for the formula you gave us, we used to use retained earning of the opening balance, and closing balance.
because you were not with me, that is why you did not hear the explanation I gave you earlier. Working number 6 and working number 7. Movement in retained earnings. As usual, we start with what? Opening balance. How much is the opening balance? So retained earnings is 119,000. You have dividend paid of, as calculated, 2 kobo of 220,000 divided by 0.8, which is 5,500. Dividend paid as calculated. What next? Do you have any other thing? Profit for the year. Profit for the year. How much?
216,500.
216,500. 216,500.
So is it 5,500 or 55,000?
It's 5,500. So 119,000 minus 55 plus 216,500. You have 330,000. 330,000. How much is the closing balance? Closing balance. That is retained earnings.
280,000.
280,000. So this thing, does it agree? Why does this fail to agree, or did this fail to agree? That means there are bonuses you made from retained earnings. Since dividend paid has been included, it's supposed to agree. There are bonus issues of what? 20,000. And that bonus issue was made.
50,000, not 20.
Okay, 50,000. There are bonus issues made from retained earnings. Now, we cannot do the movement in equity shares. We can do the movement in equity shares. Movement in equity shares, that is working number what? 7.
8.
Working 8.
Yes.
Movement in equity shares. Movement in equity shares. As usual, we start with what? Opening balance. Opening balance. You say what? How much is it?
120,000 for ordinary share.
Opening balance. Ordinary shares. 120,000. Ordinary shares. 120,000. The share premium. 30,000. We also have what? Bonus EU. How much is the bonus EU? 50,000. What is the total of that nonsense?
That should be
200,000.
200,000.
Then we have what? Closing what? Balances. Ordinary share, how much?
220,000.
220,000. Followed by share premium. How much is that? 60,000. So you have 80,000. That 80,000 is an yield of shares. More shares were issued in the period. That is why the closing balance is greater. Yield of shares, working number 8. 80,000. Inflows of 80,000. Yes, we have after that equity. We're done with equity. Then loans. Issue of loan notes. Issue of notes. The opening balance 10,000 minus closing balance 50,000. Maybe there are no notes.
There's no note on notes.
Then we have 40,000 issue of loan notes. Then another thing. That's all. Help me to add. The net cash flows from financing activities will be how much? Net cash.
Sir, the exact issue of loan note, is it negative or positive? That 40,000.
It is there an inflows.
Inflows.
So 120 minus 55. 124,500, I mean. Is it 124,500?
No. Come on, Genesis. 114,500.
80 plus what? 120,000.
Yes,
Minus 5,500.
114,500.
114. 500. Oh yeah, plus minus 134,000. minus 25,500. You have 45,000. Right?
The issue of loan note, is it 100,000 minus?
10,000 minus 50,000.
10,000 minus 50,000.
45,000. Negative, Abi?
Yes, please.
That is net cash change. After net cash change, we have cash or cash equivalent at the beginning. And what is the cash or cash equivalent at the beginning of the period?
minus 50,000, Zima minus 40,000.
Loan is an income. It's an inflow.
There was an increase in loan note, so it's an income. The difference of the increase, that's what Mr. Isika put there.
How much is the cash or cash equivalent? Your bank. The bank balance under current asset is 40,000.
Yes, the overdraft is 5,000.
40,000. That is bank.
Yes.
Let me put it separate. Bank. 40,000. Overdraft.
Overdraft is 5,000.
5,000. So you will be left with 35,000. So 35,000. Addition of the two.
That's
Minus
minus 10,000.
10,000. That is cash or cash equivalent at the end. Then you now want to analyze this. It's a muscle. It's part of your solution. Analysis of cash or cash equivalent at the end of the period. Analysis. It follows under analysis of cash or cash equivalent at the end. So, the cash or cash equivalent at the end comprises of bank. How much is the bank?
Bank is 15,000.
15. How much is the overdraft?
Overdraft is 25,000.
25,000. 15,000 minus 25,000 minus 10,000. So that is what constitutes the 10,000 we have in the solution. So this marks the end of the solution to the question. You say what?